Hi, this is Richard Chamberlain, and welcome back to the Protecting Your Family's Future podcast. This is episode number 72. Today, we're going to be talking about gifting appreciated assets. Now, last week, we looked at some year-end gifting techniques. One of those was how gifts can be made with appreciated assets. We had to go through that fairly quickly, and we got some questions asking for more detail on that. So I thought I would spend today's episode talking solely about gifting with appreciated assets. So as we looked at last week, we've got a couple of different options there. Number one, if you want to give gifts to individuals, you can gift them appreciated assets. And if you do that, then those individuals will receive your basis in the assets. And of course, that has to do with whether a capital gains tax will ultimately have to be paid on that. So let's back up a little bit and talk about that. The capital gains tax, if you don't know already, is a tax that you pay on the gain that you receive when an asset is sold. There can be short-term capital gains or long-term capital gains, but the method of calculating what the gain is the same under either tax. So let's say that you buy a piece of real estate or some shares of stock, and you pay $10,000 for that asset. Let's just call it stock. Over the years, that stock will hopefully appreciate in value. So maybe at this point, it's now worth $20,000. So you bought it for 10, it's now worth 20. So if you were to sell that stock, then you would have a gain of $10,000 and you would pay a tax on that gain. You would pay a tax on that $10,000. So that's basically the capital gains tax. So how does that work when we're talking about gifting? So if you were to gift those assets to an individual, they would receive your basis in that stock. So your basis in the stock is 10,000. If you were to sell it at 20,000, you would have a $10,000 gain. You'd have to pay tax. The individual that you gift that stock to would also have your $10,000 basis. If they sold it, they would have the $10,000 gain, and they would have to pay the tax on that gain. On the other hand, if you give them that stock through your trust or your will or by beneficiary designation, they receive it after your death, then they don't get your basis in the asset. They receive a stepped up basis. So if you bought it for 10, it's now worth 20, and you die and they inherit that stock, then their basis is now 20, not the 10 that was yours. They have a new stepped up basis. So if they sell the stock then for 20, there is no capital gain and there is no tax to pay on that gain. So you can see that it can be much more advantageous to hold on to appreciated assets if you're planning on giving them to individuals, because there will not be a capital gains tax issue if those appreciated assets are inherited as opposed to being gifted during your lifetime. Now, if you're gifting to a charity, it doesn't matter, because as we said last week, charities don't pay income tax. So if you gift them that appreciated asset during your lifetime, then they can sell that. They will have a gain, but they don't pay income tax. So there is no capital gains tax for the charity to pay. So if you're looking to make a lifetime gift, then maybe gifting to a charity is the right way to go. If you're looking to gift to individuals with appreciated assets, it may be better, more advantageous to gift through your estate plan, making the distribution to the individual after you pass away. So I hope that helps clarify some issues with gifting with appreciated assets. If you have any questions about that, how a gifting plan fits into your overall estate plan, we'd be glad to talk to you about that. You can reach out to us, and the contact information is in the show notes. So thanks for being here today, and we'll see you next week. Thanks.